From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, January 6th. Here are the top market stories that we're following for you at this hour. It's the Fed fallout, bonds battered, markets whipped, risk parity under pressure as investors reprice a more hawkish Fed. Is tech trashed in 2022? And is it full employment or just too much churn? Several Fed officials believe the economy is near maximum employment. We are just moments away from the latest real-time read on the economy with Services ISM. And Biden blames Trump. The current president accuses the former president directly for the violence during last year's Capitol insurrection. From New York, I'm Alix Steel with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, we're breaking those numbers right now.
Absolutely. The ISM Services Index comes through significantly weaker than anticipated, through at 62. Now, 62 is a pretty punchy number. It is still incredibly elevated. Remember, 50 is the kind of contraction line you want to look at. If we dip below that. So we're at 62, but last time we were at 69.1. The survey was 67, Alex. So this looks like a weak number. Is this the Omicron effect that we are seeing in the services sector?
All right, let's get to the factory orders. This is for November, so it doesn't really account for Omicron. But factory orders overall up 1.6%. But if you back out transportation, we're up just 0.8%. So that was definitely a miss. But then again, you know, it's 2 months backward read, so it's hard to really put that into the real-time economy when it comes to then the virus.
Yeah, we're also getting details on what is happening in the mortgage market. This is obviously post-Fed. The market is looking for higher rates. We are seeing mortgage rates surging to their highest level since May 2020. When did you fix, Alex? What was that number?
I fixed in November of 2020, and I fixed it 2 3/4. Thank you very much.
Feeling pretty happy about that. Let's dig into the details of all of these numbers. There's one person to do that with. We're not going to gloat too much on that number. Bloomberg's Mike McKee, over to you. What are we learning here?
Well, we're learning that Alex better not give out her address, or a lot of people who are trying to get mortgages today are going to be really upset with her. That's something that the Fed has been expecting, and it is something to keep an eye on because it may start to cool the red-hot housing market, and that might start to cool a little bit of inflation. But the inflation number in the ISM Services Index is interesting because it went up, even though the overall index went down. We're seeing prices paid at 82.5 from 82.3. So there are still inflation pressures in services, and this may be paying for some of those employees higher salaries to get them to come back to work. But interestingly enough, and Alex pointed out, this is a December number, comes when Omicron was in place. Employment drops 54.9 from 56.5. It still means that we are hiring, but we're hiring at a slower pace, and that does not match up with what we saw from the ADP number yesterday. So that's going to be really interesting going forward.
All right, Mike, hang with us because we have the question of the day, which is tech trash in 2022? And we asked that question because the NASDAQ is now off another 0.7%. It has been a terrible 4 days for tech stocks, particularly the NASDAQ 100. Romain Bostic, co-host of Bloomberg Markets The Close, is also joining us. Hey, Romain, I know you guys were all over this yesterday, too. Yeah. What are we looking at here? Like, are we looking at like NASDAQ just off its highs here and this is normal? Or are we looking at something more shifty here?
It's a little bit more structural, a little bit more fundamental, and I think the key word is fundamental. Remember, we've been basically ignoring fundamentals, at least most market participants have now for the last couple of years because of that sort of full-on embrace by the Fed, whether it's real or by perception here. But now, of course, as that accommodation is perceived to be lifted, coming down in 2022, you have to look at some of those multiples, some of those valuations. A lot of these tech stocks, they have no earnings. So if you're trying to look for a PE, there is no E to measure that PE. And those that do have an E, well, think about this. You're paying 30, 40, 50 times earnings for some of these names in the NASDAQ 100. And in fact, some of the big names in there have triple-digit price-to-earnings ratios. And if you look at it on a price-to-sales basis, it's not much better. You're basically paying almost 10 years out for some of these names on a price-to-sales basis. And that's really what's concerning people. With a higher rate environment and a less accommodative Fed, can those multiples stand up?
It's all about how high rates go. Ultimately, I think that's the question the market's trying to figure out here, Romain.
Yeah.
Mike, let me come to you on that issue. If we do QT, if the Fed decides to reduce its balance sheet, does that mean that the terminal rate doesn't go as high? And if so, is that maybe a silver lining here for the tech sector?
Well, it could be. The problem is nobody knows at this point exactly what impact the Fed's rate moves are going to have or balance sheet moves are going to have. They can anticipate that it will slow the economy and bring interest rates down some, but how much, we don't know. Part of it because of all the fiscal stimulus that went into the economy over the last 18 months. We're waiting to see what happens with consumers. Do they really pull back? The minutes yesterday didn't add anything new to that debate, but for some reason the markets decided it did. They gave us the prediction for 3 interest rate moves back in the dot plot at that meeting on December 15th. And they also suggested that interest rates are going to be or inflation rather, is going to be higher than they had thought back in September.
Can I just interject, though, because I think one part of the reaction that we saw yesterday had to do with the perception, Mike, that the Fed was moving faster than I think what a lot of people thought they were. I think there seemed to be some people in this market that thought this was going to be much more of a gradual process. You have, of course, the taper, then you have some sort of rate hike cycle, and then maybe potentially a runoff on the balance sheet. And there seems to be, whether fair or not, a sort of a reassessment here that maybe all this is going to be packed in much more towards the first half of the year rather than drawn out over maybe a 2-year period.
And which raises the question, guys, is that how can someone come in and buy the dip? I mean, Goldman Sachs talking about how hedge funds were selling technology pretty hard. I just want to point out some market action for today, guys. You got Rivian down 12%. Rivian was already getting hammered with EV stocks. GameStop down another 6%. AMC also down by 6%. And I'm just curious as to like the positioning, right, in the market from the hedge funds, from the retail investors, Romain.
Yeah, the positioning, and look, I mean, partly to Mike's point and partly to your point, though, is that there are still economic fundamentals here that do suggest a stable economy and one that's going to be stable enough to support some of those companies. All the names you just mentioned, I guess they would fall, for lack of a better word, into some sort of degree of instability with regards to their fundamentals. Why are bank stocks still getting bid, though? Why are material stocks still getting bid? There's still a bet here that you are going to have a strong economy. The Fed is going to spook a lot of people, but I think people feel that when you get to the other side of this tightening cycle, or at least you start to get the start of it here, maybe people will reassess and find something to actually buy the dip from.
Romain, what do people do, though, if they're selling tech? That, I think, is one of the key questions. Do we just do what we've been doing, which is rotating to other parts of the market? And does that rotation have the same effect at an index level? The market had got very narrow into tech. Big name tech has really been the place to be and the only place to be in so many ways. But below that, we've had this ongoing churn within the markets. Yeah. Is that what persists here? If tech is trash for 2022, is that meaning that money goes elsewhere? Or does it go to cash? Does it go to bonds?
Yeah,
I don't have an alternative.
It's a great question. I don't have a definitive answer, but I'll tell you this. I mean, you know what we saw last year. It was basically a rotation. Money wasn't necessarily flowing out of the market. It was just rotating around. I think what we've seen in the first few days of this year and even the last week of last year is money coming out. You see that reflected not only in some of the ETFs that track equities, but some of the ETFs that, of course, that track bonds as well. The question is, how long does that money sit on the proverbial sidelines before it comes back into the market? That question, I don't know. I think you may have to wait until January 26th before people maybe feel a little bit more comfortable coming back in.
Well, Mike, which I think then brings us, full circle back to the Fed here. And just for some insight, we're looking at NASDAQ 100 off another 0.8%. The NASDAQ slipping really hard after that services number missed, but inflation still higher. That equity index now down by 1%. How much of a tech tumult is the Fed going to be able to handle?
Oh, quite a bit. As Romain said, we've got some elevated asset prices, shall we say. And the Fed knows that, and they know that those stocks are probably going to go down. But as he pointed out, bank stocks, they benefit from higher interest rates, and so bank stocks are going up. It's not going to be the overall market. We may get a correction, but the overall market isn't going to die because the Fed moves 25, 50, 75 basis points this year. It's the financial stability aspect of it, they're watching, but they're not too concerned about it.
Okay, but just worth pointing out, actually, as I see it come onto my screen, Rivian now down 16. It's below 78, which is the IPO price. So we're getting some fairly punchy price action, particularly at the less profitable end of the tech spectrum. Let's put it that way. Mike, what about financial conditions? If the market falls out of bed, say we get a 10% correction, say we get a 15% correction, that's going to have an impact on the FCON function on my Bloomberg screen. How does the Fed react to that? Is it less focused on financial conditions in the way that it was, say, 12 months ago?
Yes, it's less focused because financial conditions have improved a lot, and we are still extraordinarily loose in terms of conditions. There's a lot of cash out there. The Fed's going to obviously follow that, and Jay Powell talked about this at the December 15th meeting press conference when he said if the economy comes out slower or starts to slow down, then we'll adjust our pace of monetary policy as well. The Fed is not promising you they're going to do 3 rate hikes starting in March, although the market may want to think that today. They're saying that we think the way the economy will evolve, you'll probably have 3 rate moves over the course of the year. But if the economy is faster, we could raise more. If the economy is slower, we could raise less.
Yeah, we're nearly pricing 4 at this point. We're not too far away from it. Guys, thanks very much indeed. Really appreciate the time as ever. Bloomberg's Mike McKee and Romaine Bostick. We're going to carry on the conversation, Alex. Next, we'll be putting this question to our guest. Is tech trash in 2022? Julie Beal joining us, Kane Anderson-Rudnick, portfolio manager. That conversation's next. Stay tuned. This is Bloomberg.
Powell said during the press conference very clearly they were going to go.
Is this a meaningful shift to the place where the Federal Reserve is going to raise interest rates so rapidly?
I don't think that they'll be as hawkish as they were in December.
This is the early stages of a tightening cycle. And as we know, it's usually not the first rate hike that matters. It's usually the last one.
A few hikes with real rates still being quite low and likely to remain quite low is still a broadly accommodative backdrop.
Will the Fed really permit real yields to get back into positive territory? And how will markets respond?
They're trying to create a policy that gets them on the right side of the curve. And I think that came as a little bit of a shock to the markets.
We should expect volatility to return to markets.
You're seeing orderly volatility in the marketplace.
We're in the early stages of sort of a re-rating, if you will, on where treasuries are based upon a new appreciation of Fed policy.
Yeah, no kidding. You're looking at 2-year now at the highest level since March 2020. We've seen a 22 basis point move in the 10-year real yield in just the last 2 days. Those were lots of our market voices over the last 24 hours reacting to the Fed minutes, which leads us to the question of the day. Tech being taken out to the woodshed. You're looking at the tech down by about 1 percentage point. Is tech trash for this year? Joining us now, Julie Beal, Kane Anderson-Rudnick portfolio manager. Julie, that's the question. Is tech trash?
I mean, that's like saying, like, are all brunettes brilliant? And no, they're not. Like, this one isn't. So, you know, you
Girl,
have
I'm
to
blonde. I feel you.
That's what I'm saying, right? So I think you have to show some discretion in being able to choose what you're investing in. Companies that a software business that has strong fundamentals, high levels of recurring revenue, strong profitability, that's a great business. I want to own that business. An EV company is not really a tech company, right? It produces batteries and cars, so there's no reason it should be valued like a software business. And I think that's what's going to happen is it's not tech writ large, it's being choosy among the businesses that have strong fundamentals versus those that just have high-flying valuations.
But big tech, even some of those software names are long duration assets. The valuation of Apple, Microsoft, these are stable businesses, yet they have seen so much money pour into them, Julie. And as a result of which, how exposed are they to market volatility?
I think anything that's been super over-owned and has seen a very strong recovery in its share price is vulnerable, right? We are all looking for the opportunities. And when we buy a business, it's with the expectation that the earnings can compound from here. And when you have these software businesses that are trading at very, very high valuations, that takes away from your earnings potential, right? Because you're not going to get multiple expansion from here. So I think it's really important to focus on the fundamentals relative to the valuation. There is no asset that's so fantastic that price doesn't matter. Price always matters.
Well, then let's ask the reverse question. Do you need to buy the dip? So Mark Hafley over at UBS, he had a note out saying the dip in stock seems a bit overdone. The normalization of Fed policy shouldn't dent the outlook for corporate profit growth, which remains on solid footing due to strong consumer spending, rising wages, and still easy access to capital. If you agree, what do you buy in a day like today?
Well, I don't fundamentally agree. I think 2022 is actually pretty challenging if you're the average CEO. You have rising input costs, you have rising wages, it's going to be more expensive to borrow capital. So I think it's actually a pretty challenging economy looking ahead. We don't have the level of fiscal support that we have had over the last 2 years. So I don't think it's just a slam dunk that the economy is going to be on great footing. I think you have to be very choosy and find businesses that are going to be able to look through this uncertainty because they have strong fundamental drivers in their businesses.
Do you have to be choosy and do you have to be nimble? Julie, this looks like a year in which volatility is going to pick up. We keep hearing day after day, well, certainly over the last few days, people talking about this is going to be the year when we could actually see a proper correction. I'm not sure we had one last year. If you do get that, do you need to pick your entry points? Is that when you get to the end of this year, is it all going to be about your entry point as well as what you own?
Well, your entry point really matters when you're talking about your exit point. So if your exit point is like me on average every 5 years, your entry point is a little bit less important. But if you're trying to move in and out, year in, year out, and turn over your entire portfolio, then yes, your entry point really matters. So I think it just depends what your goals are as an investor. For us, as long-term investors, we're looking for fair prices. We're not trying to be smarter than the market. We're just trying to find fair prices on very high-quality businesses.
So what are those, Julie? Because I feel like now it's, where do people want to hide out? And we've seen such a solid move into value. Where do you still find the opportunity?
I think it's less about a focus on value versus growth, and I think it's more a focus on the structure of your businesses. So I still like software businesses, particularly on the small and mid-cap side, because they're a little bit less owned than the big cap tech, and they tend to really dominate their small niche markets. So, talking about, like, for example, supply chain, we know that's a place that investment has to happen. So a company like a Manhattan Associates or an SPS Commerce that serves modernizing supply chain and automation around that's a place where investment is going to continue for a long time. And so they have strong fundamental drivers. That's the type of business that I think is more compelling to me than an EV business or a deep cyclical.
Where do you stand on the consumer?
I think the consumer outlook is pretty mixed. On the one hand, you have higher wages at the low end, which is great for the economy because those lower end consumers, they tend to spend that incremental dollar much more quickly. But that has implications for inflation, right? The volatility of money working through the system. So I think at the low end, there's opportunities for the consumer. I would look at some of the closeout retailers. I think they have a good position, particularly with supply chain disruptions. And then at the high end, we know that consumer is pretty strong. And as long as asset prices remain strong, they'll continue to buy.
Yeah, speaking of consumer, you got Bed Bath up like 8%. It was up at one point 15%. Before we let you go, energy up 8% in 4 days. Financials up almost 3% in 4 days. Are you betting on any of those kind of value stocks?
For us, I think those are the names that have the least amount of differentiation. And while they may be great buys in the near term, over the long term, it's really hard to be confident owning an undifferentiated bank or an undifferentiated energy company. Companies that are serving those businesses, I think, have a better position than the core banks and energy stocks.
The brilliant Julie Biel, thank you very much indeed. We greatly appreciate your time at the start of 2022. Julie Biel, Kane, Anderson, Rudnick, thank you very much indeed. All right, what do we got next? Coming up, President Biden blaming Donald Trump directly for last year's riots on Capitol Hill. We'll have more on those remarks next. This is Bloomberg.
For the first time in our history, a president had not just lost an election, he tried to prevent the peaceful transfer of power as a violent mob breached the Capitol. But they failed.
President Biden in the last hour speaking on the first anniversary of the riots on Capitol Hill. Bloomberg's Washington correspondent Anne-Marie Hordern at the Capitol Hill joining us now. What is the view at the Capitol? Any surprise at how strongly the president went after Donald Trump today?
I think a lot of people were very surprised and shocked because we've never seen President Joe Biden directly and squarely attack the former president the way in which he did today. I mean, he a number of times he said he's defeated president. He also said he has a bruised ego. It got a little bit personal. He really attacked the former president without mentioning him by name. And you can see it likely struck a chord with former President Donald Trump because just following the speech, we immediately got a press release of a statement from the former president. And then a few minutes later, another press release from the former president, who was also supposed to speak this evening from his estate in Mar-a-Lago, but he's punted that to next week. He'll be speaking at a rally in Arizona. But clearly, the big takeaway from the speech from President Joe Biden was really that he laid the blame on the former president for what took place. And the imagery this president painted, he really took us back to the Confederate flags we saw in this in the scenes of the Capitol across all of our TV screens, the Capitol Police that were stomped on, and just the breach of the Capitol. He brought those scenes into Americans' memories and then put the blame squarely at the former president.
And Marie, what do the Democrats now do today to kind of keep whatever unity they can within the party to push their agenda forward, but still be able to reach out to Republicans? How do they use today?
Yeah, the unity within the Democratic Party has, it's been far and few between these moments, right? Because they've been grappling themselves with how are they going to decide on what to put in a massive legislative package, Build Back Better, how they're going to go ahead with potentially getting through voting rights legislation, given the Republicans are against it, and the filibuster rule in the Senate. So they're going to use today, there's a full slate of events. Speaker Pelosi will be speaking. There'll be a prayer ceremony. And really, a lot about today, likely for the Democrats, is gearing up as well for November, those midterm elections. We know that Democrats or voters and independents came out in droves when it was about making President Donald Trump really a centerpiece of why they should vote against Republicans. But it's going to be a tough fight from here on out until November because many analysts are predicting a red wave when it comes to congressional seats and some Senate seats.
Anne-Marie, what are the chances of Donald Trump facing consequences as a result of what happened this time 1 year ago?
It's a question and no one knows, but we did hear from the Attorney General yesterday, Merrick Garland, who talked about that not one person, no matter how powerful they are, can escape the law. So some are viewing that as whether or not this potentially means the former president could become in the eye of the AG, or whether or not he's just making a very blanket statement.
Yeah. All right, Anne-Marie, thanks a lot. Really appreciate great reporting this morning. Bloomberg's Anne-Marie Hordern joining us. All right, coming up, you got U.S. hospitals facing their worst staff shortage in a year. We're going to get more on the efforts to contain the virus. This is Bloomberg. We are 1 hour into U.S. trading in this really interesting trading session. Bloomberg's Abigail Doolittle is here with the movers. I mean, first, you're looking at a steep tech sell-off, down 1%, and now the Nasdaq 100 is in positive territory.
I know, it really is a very choppy, jittery day. Investors not really knowing what to make of this week's rotation into cyclical and value out of tech. And right now we have the S&P 500 down slightly. It had been down sharply earlier. That Nasdaq 100, to your point, Alex, up just slightly after being down up. There we go, a small decline. But the bigger point for both of these indexes down on the week. The Nasdaq 100 down about 3% on the week, heading to its worst week since the beginning of October. At one point, heading to the worst week since February. That was the degree of the selling. But look at the buying in the banks and energy. So that's that cyclical trade, money coming out of tech, those higher valuation companies. The reason? Well, of course, that has everything to do with rates. So we take a look at what's happening with the benchmark yield, the 10-year yield on the week. This is extraordinary. Now at 1.72%, backing up 21 basis points in just 2 days. Of course, yesterday those Fed minutes seen as being more hawkish, as the Fed is indicating they may move more quickly than previously thought. So a bit of a catch-up move to the early indications of that in December, taking yields higher and again pressuring tech stocks because of valuation. In fact, let's take a look at some of the big names. Apple off of its lows, but nonetheless down 0.7%. Rivian down 9.4%, dropping below its IPO price. This, of course, on competition. And then Tesla, one of the big stocks that's been down recently. Nvidia, now this stock has really flipped higher. It had been down 1% more, now up 1.6%. So lots of moving parts to keep an eye on here. And of course, if we take a look at the big declines this week relative to tech, this is extraordinary. Tesla losing $160 billion worth of market cap this week. Microsoft, 143. The same for Apple. And then Alphabet, NVIDIA, and Meta Platforms all losing between $22 and $85 billion in market cap. Huge, huge numbers. Guy, let's see how today and tomorrow round out.
Yeah, in terms of what's happening around this, what kind of volume are we seeing? The volatility is obviously fairly extreme. Is there an expectation that this is a move that can continue for a while? Or is the sense maybe from a technical point of view that we're nearing the end of it? What does it look like?
I would say that the technicals do not support that we're near the end of it. If you recall, last year we took a look at the Apple chart, which the stock very extended above that 200-day moving average, and the RSI, the momentum was rounding down. At this point, we do have averages flipping to the upside, but the Apple technicals, and that, of course, is the biggest weighting to these major averages, suggest that there could be a little bit of an issue. And also, Guy, this is something very interesting on Apple. Last year, growth for the top line, I believe, was 33%. The bottom line growth, 72% on a year-over-year basis. This year, it's estimated to be low single digits. That could be a problem. So that's a stock to definitely keep in mind as we go forward.
Abigail, great stuff as ever. Thank you very much indeed. Bloomberg's Abigail Doolittle. Let's turn to one of the stocks that Abigail was mentioning, Rivian. Huge move. It's not just today. We are off our lows. We were trading a few moments ago below the IPO price. Over the last 3 days, the stock is down currently by just over 20%. Ed Ludlow has been covering this stock really since the get-go and was certainly very plugged in on the IPO day. Ed, let's talk about what is happening here. You've got a couple of things, one of which is you're getting this kind of big picture macro move as a result of the Fed. But we also had the Stellantis news yesterday with Amazon. This looks like a double whammy for Rivian.
It's a double whammy. There's been a pullback from EV stocks generally. Remember, these have stretched valuations, which is being kind, if we're being honest. And there's growing competition. You know, there's not only one option now in Tesla, there are many, and investors are trying to wade through that. But the reaction is directly to the Stellantis-Amazon tie-up, which is surprising, because we've known for months that Amazon is able to do deals with other automakers. It was spelled out explicitly in Rivian's S1 in October. It's not a surprise to anyone. I've put it in dozens of columns and stories on the Bloomberg terminal. So the reaction is sharp, and it is a little surprising.
Well, and that brings the question to me, is it who was invested in it to begin with? I mean, if someone was really looking through all the numbers like you're talking about, you knew the disclosures, you knew what you were buying. So I'm wondering if it's just a lot of retail guys in there now trading it.
We won't know for certain. I don't have a concrete answer, but this was a really oversubscribed IPO. Retail investors were desperate to get in on the act. A lot of shares were held in big blocks for institutional investors, big name institutional investors. You'll remember that they offered just 0.4% of the offering on SoFi. And in some cases, SoFi was only able to give those retail investors a single share. So they may have requested 10 or 100, and that's how they did it equitably. They said, sorry, guys, we're way oversubscribed. Here's a single Rivian share. Imagine that, holding just one share and getting involved in an IPO that way.
Yep, I think I literally know someone who wanted to do that. Ed, thanks a lot. I really appreciate it. Bloomberg's Ed Ludlow. Thanks for the hustle. Rivian, though, off its lows, down just 9%. Super whippy action for tech stocks today. Something else that we're watching here, the latest developments with the virus, Guy. It felt like the Fed kind of looked through all of that, but on a real-time basis, it's going to impact the day-to-day of the economy.
Absolutely, and maybe we saw some evidence of that within the numbers we got on the ISM at the top of the hour. Yeah. Maybe some evidence starting to creep into the services side that we're having problems there. Certainly, if you take a look at the wage component there, the inflationary component there is certainly evidence that we're having to pay out more, but there are less people in the workforce. And I think this is going to be something that shows up in the data tomorrow. And countries around the world are getting kind of much more militant is maybe the right word on what is happening here. You look at the story out of Italy, for instance, the over 50s. It is now mandated that they have to be vaccinated. The French president in Parisienne just a couple of days ago talking about peeing off the unvaccinated. Countries are turning much more hostile to those that are unvaccinated. And the obvious kind of the lightning rod here is Novak Djokovic. Look at what is happening with him in Australia. He went down to try and play in the Open. He's now been detained. He's in detention effectively. This after a court ruled in that country against his legal challenge, asking for a vaccine exemption. He is unvaccinated. He was going to the country to defend his Australian Open championship. The country requires all visitors to be vaccinated. The Prime Minister really not giving any ground here and certainly not prepared to give special treatment.
On the issue of Mr. Djokovic, rules are rules, and there are no special cases. Rules are rules. It's what I said to you yesterday. That's the policy of the government.
The rules are really clear, particularly for the no tolerance COVID policy numbers. And it really comes down to vaccinations. And Bloomberg crunched the numbers and found this great heat map of the whole world in terms of vaccinations. More than 9 billion doses of the COVID-19 vaccine have been administered across 184 countries. That's 120 shots for every 100 people worldwide. Still, many are resisting the vaccine. Still, we can't get the vaccine to different areas. You can see the darker the green, the more vaccination take-up there is. Well, joining us now more to discuss is Sandro Gala, Boston University School of Public Health Dean. Do we need a carrot or a stick to get people vaccinated, Professor?
We probably need a bit of both, and I think many countries are doing a bit of both. I think the carrots are the opportunities to do more and more things if you're vaccinated, to be able to attend events and all that. And some places are also doing sticks, which is the actively keeping people from going places if they're vaccinated, or even employers, people not being able to have full particular employment, or in some cases, fines are being considered.
There seems to be the sense that the unvaccinated are crazy, that they are out there to defeat society. When you look at your research, is that the case? We seem to be treating them as this kind of unified body. How should we be segmenting that group?
Yeah, I don't think that's a fair sense. I think that there has been people who are against vaccinations since we've introduced vaccinations. There were protests and riots in London about the smallpox vaccination. I mean, this has extended all throughout history. And there are many different groups of people who are unvaccinated. You have a group of people who are unvaccinated because of religious beliefs. There's a group of people who are unvaccinated because of mistrust in authority and mistrust in government. There's a group of people who are don't want to be vaccinated because they're contrarian by disposition. These are very different groups. And of course, we shouldn't forget the fact that when you look at the global map, a lot of the areas where there's low vaccination is not because of hesitancy, but it's actually because of limited access. And those are very different issues.
Exactly. And so I wanted to get to that latter point. It feels like until we get real vaccination take-up, the mutations for the virus are going to keep happening, and we don't kind of know what the next one's going to bring. How do we get more vaccines to emerging markets that need it?
Yeah, so the emerging markets are a really complicated story, and you showed in the map sub-Saharan Africa has been particularly low, about 5 to 10% vaccination. And even in sub-Saharan Africa, it's not a single block. There are countries where there is tremendous vaccine hesitancy, largely due to mistrust of Western medicine's traditional, and that has decades of deep history. And some of it is actually due to lack of access. So this is a country by country, region by region, district by district, city by city approach. Fundamentally, I think we need to make sure that vaccines are available to everybody at the local level as much as possible. And then we can tackle some of these really difficult issues of groups who, for religious reasons or for political reasons, have been resistant to being vaccinated, even if they're available to them. And, Djokovic, which you discussed a second ago, is a really interesting example. Here is the most prominent tennis player in the world who has complicated reasons, as best as one can read, religious as well as health reasons, at least as he states them, why he doesn't want to get vaccinated. And I think it really exemplifies how complicated some of these reasons for people not wishing to get vaccinated are.
The French president making clear his views over the last few days on the unvaccinated. What effect do you think vilifying the unvaccinated will have?
Yeah, it's been entertaining watching that. I'm not sure that vilifying anybody ever has a positive effect. Frankly, I actually think that the approach, the more productive approach, is a more big tent approach that tries to understand where people are and really leans into providing the reason. And the reasons are both selfish and selfless. There are reasons to get vaccinated, both to protect yourself, but to protect others, to protect yourself and to make sure that the system is available for others. But I also think there's a bigger question here, which is what happens, not now, but what happens with the next pandemic when we also need vaccines? And what we're learning now is that trying to deal with issues of trust on the fly when there's a pandemic happening is really impossible to do. And we need to make sure we invest in trust and systems before the next pandemic. And what we do now will influence what happens in the next pandemic.
Where do we have the best shot globally of getting more vaccines and arms?
Well, from a simple denominator point of view, the countries where there's low vaccine uptake so far stand to gain quite a bit by making a bigger effort. So that would be principally the African countries. But the point you made earlier about the fact that we're going to have more different strains emerging if we do not vaccinate more people, even in Western countries and high-income countries, is also a valid point. So I do think that one needs different efforts, and efforts in countries where there's been low uptake and efforts in countries where there has already been pretty high uptake. You know, I don't want to get lost in this conversation that the global vaccine effort actually has been overwhelmingly a success. And you mentioned correctly, 9 billion doses have been administered. We've administered 9 billion doses of a drug for a disease that we had never heard of as recently as 2 years ago in less than a year period. That actually is quite remarkable. So we absolutely should be talking about the challenges of getting vaccines to everybody. But I don't want to lose in that the fact that from one level, and I think perhaps the dominant level, the global vaccination effort has been an extraordinary success.
Sandro, yeah, I think it's a point well worth making. The effort has been Herculean. We really appreciate the smart insight. Thank you very much indeed for joining us today. Sandro Galea, Boston University School of Public Health Dean. Thank you very much indeed. Coming up in around 24 hours, we'll get the latest read on the US labor market. December jobs numbers out tomorrow. We've got some great coverage lined up. We're going to set you up for that number. Nicholas Bloom of the Stanford Institute for Economic Policy Research joining us next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Council on Foreign Relations President Richard Haass. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Russia and its allies have sent troops to help quell protests in Kazakhstan. The demonstrations were triggered by fuel prices, and they're seen as the biggest threat to the former Soviet Republic's leadership in decades. Police said that dozens of anti-government protesters were killed by security forces. Applications for U.S. state unemployment benefits rose last week, but they still stayed near historic lows. Jobless claims totaled 207,000. That was up 7,000 from the previous week and was higher than expected. Claims have been hovering around a 5-decade low in recent weeks. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Thank you very much indeed, Ritika. Let's pick up where Ritika left off. The labour market. Economists forecasting 440,000 jobs being added in the United States in December. We're going to get the data tomorrow. Now, according to the Fed's latest minutes, which have caused such a stir, the US is definitely moving in the right direction. This is one of the quotes from the statement yesterday. Quotes, acknowledging that the maximum level of employment consistent with price stability may evolve over time. Basically, that's code for we haven't got a clue for where our star is. Many participants saw the US economy making rapid progress towards the committee's maximum employment goal. Well, let's talk about this ahead of the payrolls numbers tomorrow. Nicholas Bloom, Professor Nicholas Bloom, Stanford Institute for Economic Policy Research Professor and Senior Fellow, joining us now. Nicholas, great to see you. Happy New Year. Are we at full employment?
Well, you know, as they said, it's one of these things that moves over time. I would say right now, as in, you know, the next 6 months to a year, it's looking like we are in the US. So to be clear, unemployment is at incredibly low levels. You saw earlier in the week, quit rates are at all-time high levels. Those are pretty good indicators of hitting full employment. So we've lost about 5 million employees since before the pandemic, but those 5 million don't look like they want to come back to work anytime soon. So amongst everyone else, I think we're close to full employment.
Well, but what I keep getting confused about is the signals in the job market that to me make no sense. Like job openings remain really high, but then some workers are still reporting like 13 weeks to land a new job, and then quit rates were the highest in years. How does all of this make sense? How do we learn that this is full employment?
Well, nothing makes sense post-pandemic. I mean, this is, you know, it's like one of those science fiction movies where you've landed on an alien planet and everything is different. We're doing the best we can. And I think the best indicators or the best story is really there are about 5 million people who have just given up wanting to work. Roughly 2 million may have retired early, and maybe another 3 million don't want to work in conditions that are on offer. They don't want to wear a mask. They're worried about infection risk. As a result, that 5 million gap is not going away. And of those that want to work, they are receiving typically multiple offers. And that's why quit rates are at incredibly high rates. Unemployment's very low. Now, there may be some people out there that can't find the job they want, but that's possibly because the job they want doesn't exist. So if you think you want a pre-pandemic job in retail without wearing a mask, without infection risk, without social distancing, that kind of job is just not out there. So some of these folks are waiting. They may come back later in the year, next year, but in the next few months, it doesn't look like they're about to start working again.
So what kind of labor market inflation should we be expecting this year in the United States?
I mean, I'm worried. When you see quit rates at all-time highs, I talk to a lot of firms. They are struggling to hire people. It suggests that, wage inflation is starting to take off. I'm not surprised the Fed is thinking about pretty rapidly putting up rates. I mean, one thing I hear over and over again from employers is they have to sweeten the deal. So when they can, they offer work from home. For a lot of firms, probably many employees of firms listening are offering, in addition, this 1 month work from anywhere. Things like that are ways to try and attract people in a very tight labor market.
Yeah, exactly, which is also sort of like, do we really need to measure wages, or is it the ECI that makes the most sense? Employment cost index, you have to factor in all of these kind of things. So tomorrow when we get the numbers, what's going to be the most important thing for you? The overall employment numbers in some ways is the key thing to look at. To bear in mind, before the pandemic, we were gaining about 200,000 to 300,000 jobs a month. If it turns up to 450, there's some healing going on. But remembering we're short of 5 million jobs, if we're on 450, that's 150,000 extra jobs. That's not going to eat much into the big gap. So, we're in a very weird world. We got to amazing levels of employment in 2019. Long run, we'll go back to that. Work from home, for example, is very good at bringing marginal people into the labor market, but it's going to take time. I think we have to see this now as we're in a much slower healing phase from the pandemic. And, we have to go back to normal interest rates and normal markets.
Is working from home now a permanent feature? I read your notes a little bit earlier on this morning. 40% probably going forward from here will have some sort of hybrid work. Wow. Is that something that we just now have to get used to? And how different is analyzing the labor market going to be as a result of that?
So, yes, it's permanent. I mean, it seems like a win-win, to be clear. Hybrid, which is, for example, you come into the office Tuesday, Wednesday, Thursday, you work from home Monday, Friday, appears to improve productivity and keeps employees much happier. So, it's become the dominant strain of working patterns for those that can. So that's here permanently. I don't think it's not going to affect labor markets too much in the short run. In the long run, it's probably going to increase participation. So there are a lot of people, older workers, maybe people with young kids, some folks with disabilities I talk to that say, if I can work from home 2, maybe 3 days a week, I'm going to stay working, or I'm going to work full time. So, it's great now. It's great in the long run. That's one of the few good things to come out of the pandemic, is that work from home has really taken off.
That's a really interesting take. I don't think I heard that one before about future participation. Nicholas, thanks a lot. We really appreciate it. Nicholas Bloom of the Stanford Institute for Economic Policy Research. Thank you very much. We are about 40 minutes away from the European close on this very whippy market action day. NASDAQ 100 now up by 0.3%. This is Bloomberg.
34 minutes to the European close. Let's check the price action on this side of the Atlantic. European stocks off their lows. We gapped lower first thing this morning quite sharply in reaction to the Fed minutes. We've climbed a little bit, but the stock 600 now 487, down by 1.32%. Luxury stocks are under pressure. Tech stocks are under pressure. Brent crude, though, climbing up by 1.73%. We're north of 80, convincingly now 82.16. TI just kind of flirting with that 80 level, and the dollar's back in charge. We're below 113. Euro dollar trading at 112.95. The virus continues to dominate much of the news flow, but it is now obviously competing with the Fed for the market's attention. Rasmus Beck-Hansen of Airfinity is going to update us on the latest data on Omicron next. This is Bloomberg.